All right, let's jump straight into this deep dive stock analysis of commercial stage biotech Omeros Corporation. Today, as an investment analyst, I'm putting Omeros through what I like to call the Guru Gauntlet. We are going to take this company's latest first quarter 2026 data and run it through the legendary investing filters of Warren Buffett, Peter Lynch, Benjamin Graham, and some modern valuation modeling. We've got a seriously fascinating situation on our hands here. This is a biotech that just pivoted into the commercial stage. They're flush with cash from a massive new partnership, but they're still carrying all that historical baggage of steep clinical research costs. So let's see exactly how the absolute greats would evaluate this setup.
Since this analysis gets pretty dense, here's our roadmap. 1. Omeros Company Snapshot. 2. The Warren Buffett Lens. 3. The Peter Lynch Lens. 4. The Benjamin Graham Lens. 5. DCF and alternative models. And 6. Synthesis and final recommendation.
Okay, Section 1. Omeros Company Snapshot, taking a look at their biotech pivot.
So, Omeros, trading under the ticker OMR on the Nasdaq, is a commercial-stage orphan biotech company sitting at roughly a $1 billion market cap. Their lead product is called Yartemlea. It just launched in January 2026 after bagging FDA approval for a rare disease called TTMA. But here's the kicker that completely reshaped their balance sheet. They just inked a partnership with Novo Nordisk for another drug in their pipeline. That deal injected a massive $240 million in upfront cash, leaving Omeros with about $135.3 million in cash and investments at the end of the quarter.
Now, what's really interesting here is the story hidden inside their income statement. At first glance, they report a Q1 net income of $56.1 million. So a profitable biotech, right? Well, actually, scratch that. If you look closely, you have to back out a $73.1 million non-cash derivative gain that's tied to their convertible notes. Once you strip away that paper gain, it reveals a true adjusted net loss of $17.1 million for the quarter. Still, it's worth noting they brought in $9.9 million in net sales from Yartemlea in its very first quarter on the market, which is a highly encouraging launch metric.
Moving right along to Section 2, the Warren Buffett Lens, where we weigh moats against margins.
For Buffett, you know the drill. The first question is always, does the company possess an economic moat? And for Omeros, surprisingly, the answer is yes. Yartemlea is literally the first and only FDA-approved treatment for TATMA. That gives it orphan drug exclusivity and real pricing power. But unfortunately, this slams right into a brick wall when it comes to Buffett's absolute requirement for historical earnings consistency and high return on equity. Because they spent years grinding through clinical trials, Omeros has zero history of consistent earnings, a negative ROE, and a massive accumulated deficit of $857.6 million. Buffett wants to see strong owner earnings, basically free cash flow, and right now, that number is in the red.
But hold on. If we check Buffett's requirement for manageable debt, Omeros actually passes with flying colors. They took that recent cash influx from Novo Nordisk and completely cleared out their bank loans and their 2026 notes. So today, they're left with only $70.8 million in 2029 unsecured notes. When you stack that against their $135 million in cash, that is an incredibly clean balance sheet. However, because of that lack of historical earnings consistency, Buffett would absolutely pass on this. It just doesn't fit his framework.
All right, Section 3. Let's look through the Peter Lynch lens at the turnaround story.
Now, Lynch loved to categorize companies. In Omeros, it's a textbook turnaround or asset play. Think about it. Just a year ago, the market was terrified about their looming debt wall and their shrinking cash runway. But today, as this analyst perfectly sums it up, the story has completely pivoted from will they survive to the decision date to how well can they execute on a first-in-class approval and a rare disease partnership.
And Lynch would absolutely love this setup. He always hunted for a rapidly improving balance sheet. And as we just saw, Omeros now has way more cash than debt. But here is the ultimate Lynch buy signal: insider confidence. In Q1, Omeros actively bought back 360,000 of its own shares at an average price of $11.70. When management uses precious cash to buy their own stock right as a new drug launches, Lynch sees that as them screaming confidence in their future cash flows. Now sure, we can't calculate a traditional PEG ratio here because there's no positive EPS yet, but for a turnaround investor focusing on that balance sheet, Omeros looks like a really strong buy.
Okay, Section 4, the Benjamin Graham Lens, the strictest numbers test of them all.
Running this through Graham's defensive investor checklist is honestly pretty brutal. Graham demands hard, trailing quantitative proof, not future promises. Adequate size? Sure, a $1 billion market cap gets a pass. But after that, it's just strike after strike. Strong financial condition? No, they're sitting on a shareholder deficit of over $63 million. Earning stability? Zero history of positive EPS. Dividend record? They've literally never paid one.
And it gets worse when we try to calculate Graham's famous intrinsic value formula. You take the square root of 22.5 times earnings per share times book value per share. For Omeros, it completely breaks. You physically cannot do the math, because taking the square root of negative earnings and negative book value just gives you an error. It perfectly demonstrates where strict value investing hits a wall when analyzing a commercial stage biotech. To Graham, this is wildly speculative. His verdict? A definitive sell.
So let's move to Section 5, DCF and alternative models, where we actually forecast the future.
Since the backward-looking models fail, we pivot to a discounted cash flow model. By forecasting the free cash flows from the Yartemlea launch, we can pinpoint a fair value. But remember, this is largely a single commercial asset biotech right now, so we have to slap a high discount rate on it, say 12 to 14%, just to account for the execution risk. If we pull up a sensitivity table and assume a 12% discount rate with a 3% terminal growth rate, we land at a fair value of roughly $11.30 per share. What that tells us is the stock is currently trading right around its fair value, and everything from here depends entirely on how well management executes this drug launch.
Alternatively, we can run a sum of the parts model. It's like putting together a giant puzzle to uncover their hidden assets. First, you've got the value of Yartemlea's commercial runway in the US, plus potential approval in Europe. Then, you layer on the massive potential of that Novo Nordisk partnership. I mean, they're eligible for $100 million in near-term milestones and up to $2.1 billion in total deal value, plus royalties. You subtract out that $70.8 million in remaining debt, and a sum of the parts model reveals significant upside, but only if they actually hit those clinical milestones.
Finally, Section 6, Synthesis, and our final recommendation.
Take a look at this summary matrix. It is absolutely wild how it highlights the divide in investing philosophies. Traditional value purists, your Buffetts and Grahams, they're running for the hills because of the negative earnings and the shareholder deficit. But then, growth and turnaround specialists using a Peter Lynch framework, they see a beautifully de-risked balance sheet, heavy insider buybacks, and a brand new revenue stream. And sitting in the middle, modern DCF modeling calls it a hold, suggesting it's fairly priced in that $10 to $12 range today while we wait for execution.
Ultimately, the big takeaway here is that Omeros is a high beta stock. Its valuation going forward is literally tied to real-world Yartemlea sales and whether Novo Nordisk hits those massive clinical milestones. The balance sheet is finally clean, the product is approved, so it really leaves us with one burning question. Is the current financial reality just the darkness before the dawn?